All right, so the markets responded to this jobs number, and for that matter, the revisions to prior months in jobs numbers in a negative fashion. A lot of Fed speak today before they go into their quiet period in terms of what they're going to do with rate cuts. So that moved the markets today. So we're going to take a look at how this market kind of broke down this week and produced some bearish signals and what they would suggest going forward. How much further? Where is there support to the downside? Has this move been enough? Are we going to just bounce right back up to new highs now? What kind of bounce will we get if we get one next week? We'll talk about that. Break down all the technical aspects of this move from a short-term perspective as well as from a long-term perspective. There's some interesting longer-term signals that were produced by the end of the week. So I'll break those down as well. Taking a look, of course, what's driving the action today. I think we finally are getting our broadening move. It might not be the broadening move that a lot of people kind of expected or wanted, but it is a broadening move. So we'll talk about that. And then our trade idea is another trade in the mega cap space. We did yesterday, the Magnificent Seven space. We'll do another one today and talk about how to trade a stock that may be looking, that the market may end up looking like here eventually. And we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, September the 6th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Scroll down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It takes you to our Facebook page. Click that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the day on the down, finished the week, on a down day, finished the day at the low, near the lows of the day, ended up with a bull tag. So light pink shading in the yellow line, coming off of dark green shading in the green line just the day previous. The intermediate line is now out of the reversal zone, so we're below the 80th percentile. Short-term sentiment remains bearish, especially the momentum line is extreme lows there. So you can kind of see we are, headed towards a pullback here, unless we bounce significantly. But we're more than a percentage below on this bull tag. We're more than 1.25% below the moving average, which means pretty good chance that we'll probably will not bounce off of this. The Nasdaq 100 obviously did not get a bull tag because we went straight to a red line when we crossed below the moving average earlier on Monday. Obviously clearing a lot of lows, filling in a gap from August the 13th. And you can see the intermediate line now is actually almost out of bullish territory. Short-term sentiment, very same as the S&P 500s. Market sentiment is actually lower than the S&Ps. It's already out of bullish territory itself. When you look at the Dow Jones Industrial Average, it also got a bull tag today, just barely below the moving average though. So you can see when you get those ones that are barely below the moving average, they tend to bounce back up. So we'll see if that ends up being the case. The intermediate line is out of the reversal zone, below the 80th percentile, still above its rising market sentiment line. Well, actually, it looks like it says it's slightly falling, but it would be like very slightly falling. Bearish short-term sentiment, just like on the S&P, maybe not as bearish, but still pretty close. Finally, the Russell 2000, you can see the intermediate line has crossed below market sentiment. It's out of bullish territory. The near-term line is a lot worse than all the others, so it continues to be, a lot more bearish. Light pink shading. I mean, in fact, you're that close, 0.15 away from dark pink shading, right? That's when the light pink turns to dark pink when you cross below the 50th percentile. So you're that close to having dark pink shading in a red line. So you are in intermediate pullback, essentially, on the Russell 2000, barring a significant jump on Monday. Let's take a look at the weekly. Since this is the end of the week, let's take a look at the weekly market forecast for the S&P 500. And you can see we are down, very bearish short-term sentiment. The near-term line now is below 60. So remember, you have two periods, in this case 2 weeks, to get from being above 60 to below 20 if we're going to produce a bearish near-term low. And it would be like, again, this is a very bullish near-term high. So this would be the first of a trend if we're going to be bearish here. So we'll see. Next week's a really important week to see if the near-term line follows the near-term line or momentum line all the way down. The NASDAQ 100 actually got a bull tag on its weekly chart. And again, bull tag barely below. These bull tags can be really bullish, like long-term bullish signals. The difference again between this one and this, they're both is barely below the moving average. This one, the intermediate line is actually above the market sentiment line and it's rising. Here, we're actually well below the market sentiment line and actually almost out of bullish territory. Again, short-term sentiment's bearish, very extremely low momentum line. The near-term line has dropped below 60, first period below 60. Momentum line's well below it. It's actually below 40 on the first period below 60. So, a pretty decent chance that this bull tag, instead of producing a nice bounce, ends up producing a correction, right? This would be a correction on the weekly chart. Looking at the Russell 2000. Again, not quite, we didn't quite get the yellow line, so we didn't quite get the bull tag, but you see how close we are to it. The intermediate line has crossed below its market sentiment. What was a bullish near-term peak is now, obviously same thing, oversold momentum line, near-term line falling from out of bullish territory, so that's the first period, and we'll see for the next period. So you see how things really changed this week pretty dramatically on the market forecast, leaning towards not just the beginning of a pullback, but more the beginnings of a correction, right? Which, remember, is a drop below, eventually, below the 200-day moving average. You can see we did drop below the 10-week. The 200-day moving average would be the 40-week, so we're still well above it for now. But we did cross below the 10-week, the red arrow there. You got a transition candle, so and that transition candle ended up being a pretty bearish candle. So you would expect next week's candle is going to be pretty bearish as well. If you look at the NASDAQ 100, same thing, right? Bearish candle, red arrow. The PPO is falling at pretty decently high levels too. Pretty decently sized bearish candle, given that we're just starting a potential pullback here. So you can see how things are bearish from that regard. You have 3 red arrows now on everything except for the Dow. The Dow didn't quite, the diamonds at least, didn't quite get below the moving average. The Russell and the NASDAQ, remember, had 3 red arrows already. This is the third day. This is the 4th day. It doesn't look like we're going to get like we're going to stop this anytime soon. Remember, the 3 red arrows can be a very bullish signal, but it can only be red for like 3 reds for like only a day or two. Once you're past that first day or two and you've built upon that signal to the downside, now it gets hard, right? It gets hard to move up. If you break this out into the 2-line versions of this, again, you can see the S&P 500 breaking below the 50 and the 30 and the 17 in the last couple of days. So it's a clear breakdown. We are in pullback mode. That's why now you see the my little icons I have on my Market Outlook tweet and in the email are all is bearish now, because I believe we are in pullback mode here. The MACD has gone negative. Stochastics is in bearish territory. You see that as well on the Qs. The Qs, in fact, it's pretty darn close to the 200-day. The MACD is way negative. So the S&P is kind of catching down to where the Qs are. IWM is also breaking below all those moving averages. Again, the point of control is at the 200 days, same as the NASDAQ. They're negative on all these levels. So it looks like we're going to be retesting down to the August 5th lows. I don't think we'll break through because there's a lot of support here. And there will be a bounce off of these lows before there's any kind of correction. So keep that in mind. Remember, all pullbacks bounce. The corrections are when the pullbacks fail. Those bounces fail. So all pullbacks bounce, and so you can see where we're going to bounce. We're going to most likely retest these lows and bounce back up. The question would be, do we bounce up to new highs? We didn't there, and I don't expect that we will this go around either. If you look at the 5-year weekly chart, one of the other reasons why I think that's the case is you can see IWM is broken below the 17-week moving average, and the MACD has gone slightly negative. That's on IWM. On the Qs, You can see it's broken below the 17 and the 30, and your MACD has been negative, and it's now close to crossing zero, which, these are all, that happens. The MACD crosses zero during corrections, not just pullbacks. It gets to zero on the pullbacks or a little bit above it. It crosses zero on and again, it crosses the 17 and the 30 on corrections, right? It moves towards that 200-day. So SPY is not quite as bad, but it is below the 17-day or 17-week barely. And your MACD is negative. Your stochastics, you can see, is kind of diverging with these lower highs with the higher highs. Same with the MACD. So, and not as close to zero, but you see how, again, that's when we get the corrections, when that weekly crosses below zero, and it looks like we're on our way for that. Looking at the DMI, we are bearish now. So remember, we hadn't been bearish because the negative hadn't popped up. Now we are. It's popped up above 25 or below 20. Your ADX is now rising. So we are trending, according to this indicator, to the downside. You're above 30 now in the Qs and well below 20. So your ADX now is above 20 and rising. So I mean, we are clearly in a bearish mode there as well. Excuse me. When you look at the RSI and the CCI, that's how close we are to dropping below 40. So we are really close to this green box ending. Remember, it ends when it crosses below 50, but only if that move below 50 ultimately gets below 40. That kind of confirms it. So it hasn't yet, and we're close. We're below minus 200 on the daily CCI. That's a big bear. That we don't get this low when we're bullish. We only get this low during pullbacks. You can see the weekly CCI drop below zero. So again, once you break below the minus 100 level, this green box ends, and that's how close we are to that happening. The NASDAQ 100. That's how close we are to that happening for the NASDAQ 100. As its daily chart, the RSI did break below 40, and we are well below minus 100, minus 150 there. So again, all these indicators are telling us we are clearly in a pullback mode right now. If you look at the Bollinger Bands and the Keltner channels, excuse me, we are in the lowest quartile of the bandwidth. It's really declining. The bandwidth has not quite gotten into the Keltner channels yet, and we are really close to breaking outside of the lower Keltner channel on SPY. And the Qs are even further into the lowest quartile, and we have broken below the lower Keltner channel. So that's really bearish for the Qs there as well. That's a bearish signal. Let's take a look at the intraday moves. The S&P 500 did not produce a new 4-week low point, but we did get out lower high and a lower low. And you see we did close in the lower half of the chart, well below last week's low, right? Remember, the NASDAQ kind of flirted with last week's low last week, but finished above it by the end of the week. Well, this week, on Tuesday, excuse me, we easily broke down, and then now we are clearly, in fact, we are very close to a bearish crossover here on the Arun indicator, which would really solidify the change in trend. I mean, the low point is right here, right? So, this zero level is right here. So once we get done with tomorrow, the low points can move up here, and this is a lower low. So, we're going to get a crossover on the next period, a bearish crossover. The difference will be whether or not we get a lower low on that day to produce, a 100 level here. IWM has been the one that's been kind of crazy because it got that one touch, right? Well, you can see it's also very close to producing a new 4-week low point as well. In fact, when you look at the where we are in the range, I mean, we are well in the bearish territory in the S&P. In fact, the average is starting to turn over. We're so far below the average. I mean, that's a bearish sign. The NASDAQ 100 is into the lower reversal zone, well below the 20th percentile. The 20th percentile here, and you can see again, like, we are clearly in bearish mode there. The Russell 2000, same thing. Below the moving average, into bearish territory, and its moving average is slowly turning lower as well. When you look at the today's volume and trading range, we'll look at it for the week too, but let's start off on the daily volume and trading range. You can see that well above the average, 12 points, volume at 68 million. So that puts That gets our relative ATR rising again. It's almost back above 1.5% already. And then you can see the volume is starting to turn up. But what's even crazier is the weekly. You can see the weekly has been trending higher already as it is. And this week we had a 21-point range for the week, and that range is well above the average, the ATR. And the volume is really light. But when you look at the weekly volume, the average volume has been really light. But if you look at the weekly volume for the week, again on a 4-day week, it was equal to the last few weeks on 5-day weeks here. So pretty decent move, and the same thing on the Qs as well. The ATR are starting to pick up, right? The ATR, the volatility dropped as well. And when you look at, bounced as well. You can see it jumped up above 20. It did not get above 100. It closed lower by the end of the day today, which usually is what happens on Fridays. But it still finished the day above 20. It still finished well above 95%. Again, getting above 100% is what kind of tips the scales towards being a intermediate pullback. And your VVIX stayed above 110, right? In fact, we're close to 120. So again, until that breaks back down below 110, we're susceptible to bigger moves, right, on the VIX. And this really wasn't that big of a move. It's a 12% gain. But if you look at the move that we had on the VIX, 12%'s a big move, but it's not too extraordinary. Now, when I look at the weekly move on the VIX, it's one of the biggest weekly moves that we've had in quite a while. In fact, you have to come up here to 40, right in this area. You have to go all the way back to 2022 when the correction started in January of 2022. You also had it this is when the correction started for the Russell in that week of Thanksgiving. You also had a big move up higher there. You also had one there in January of 2025, and the VIX dropped. And the VIX dropped on these too, not so much on 122, but this is a high. Like, we've had multiple weeks now in the past little bit of pretty strong moves. That's in what, 1 2 3 4 5 6 7 8 3 weeks in 8 where we are 30% or higher. That's obviously not typical. You can see here 30%. So there's 3 weeks in a row. Like, you've got 2 here, you got 2 there, you got 1, 1, 1. Like, they're all spread out. We over here in COVID, we had 3 and 7, and obviously one of those 3 was a huge move up higher, 134%. But that's obviously looking back, even in 2022, we never had a big jump in volatility like this. In this case, over again 8 weeks. So if I were to go to like a rate of change, where's the rate of change? Right there. And pull up the VIX, and then again we'll do an 8-week rate of change because that's where we've been. So eight periods here, and then we'll switch this to a weekly chart. So there we go. So again, up 79% in the last 8 weeks. That would include 1 2 3 4 5 6 7 8. There's your move. Now obviously over here you had a pretty good run to the upside because of lower basis. 1 2 3 4 5 6 7 8. So that was a pretty good jump of about 91%. So here we are already in just 1 week. We're up to 79. And just for some context, that's how we don't typically get bigger these kind of moves. We did in 2018. We did at the beginning of 18, also in COVID. You can kind of see there in 15 and 16 the correction there. 2011 the correction. 2010 the correction. The correction that started the bear market in 07, that kind of preceded that first cut that we had at the end of 07. So this was a big move on the VIX to the upside. And when you look at it from this perspective, it doesn't look extraordinarily large. It's not any higher than where we were last fall. It wasn't not much higher than where we were earlier this year on a normal little pullback. So it makes you wonder a little bit how much more is kind of left in this tank. We don't have a 5% drop yet, but that's how close we are to getting a new red tag. The NASDAQ does have a 7% drop. The Russell 2000 also has a almost 6% drop. So we are clearly in pullback mode on these. Now the question is how much longer this pullback will last. and whether it will turn into whether the bounce will fail, because all pullbacks bounce, whether the bounce will fail and will actually turn into correction, which a lot of these indicators are suggesting that we will, because of the size and scope of this particular decline this week. All right, now let's talk about what's been driving this move, and let's take a look at the week. So let's come to the asset class comparison chart, and again, we'll just go to the on Tuesday when this week started. So there we go, September the 3rd. And there we go. There's our move. So bonds are the big move higher. Even global bonds outperformed everything else. Gold and the dollar both down a little. Commodities got hammered. Equities got hammered. U.S. equities got hammered. Emerging markets got hammered. Small cap stocks got hammered. Large cap stocks got hammered. Mega cap stocks, which is basically what the Qs are, got hammered. Everything got hammered. So this was a broadening. There's been a lot of talk about broadening. Here's your broadening, right? Everything going down. This week. Now, granted, when you look at like the sectors over this past week, not all the sectors went down. So here's your broadening from a sector standpoint, right? We are now broadening into the safety trade, right? Because those are the only sectors that really did not drop 2% or more. And even healthcare would be considered safety. So all the other cyclical areas dropped 2.5% or more over the course of this week, with the market down 4% and XLK especially down 7%. And remember, that's the big driver, because that's where the bulk of the sector weighting comes from. And that's the scariest chart. So when you look at XLK here, it has really broken down below that 17-week 17-week moving average. That's a big decline there. Where the ratio chart's below its 50-week moving average. See, it wasn't below the 50-week, just barely on that one, and wasn't below it at all during this pullback. Now it is, right? And that's what happens in 2022 when you're below the 17-week and the ratio is below the 50-week moving average. That's when you're in correction mode. So that's a concern. That's a big concern. If you look at NVIDIA relative to the S&P 500, try this again. There we go. You can see it has also broken its 17-week and hasn't done that since back over here, and it's still well above its, there's still a lot of room for it to fall. Like the relative strength is way up here. So, it's not threatening, but you can see again, early 2022, same thing happened, right? Same thing happened, and we had negative momentum. We had relative strength that was still pretty high, about the same level as we are right here at 109. It was at, it doesn't say where it was at, but right about this area here is where we were on this week. That's actually up here. So a little bit higher, and the momentum is more negative now and a little bit higher against the ratio, but we have that's what happened when NVIDIA started to underperform. And, if we get something like that again, then we're kind of in trouble, right? And this is the NVIDIA, this is the actual ratio chart of NVIDIA to the markets. This is on a daily chart. And you can see we're filling in. We're pulling back towards the 200-day moving average. And the question is, will we break the 200-day moving average like XLK already has, right? When you look at XLK compared to, eventually, give that up here. When the XLK has broken below the 200-day moving average on its ratio chart relative to the S&P 500. There we go. So you can see, in fact, we have a death cross now on there. And the MACD, the long-term PPO, is now negative, right? So that's your death cross on the daily chart. So here's the 5-year daily, just to give you some context on that. That long-term is negative. It doesn't get negative unless we're in correction mode. Here is the weekly version of that ratio chart. Remember, we're also below the 50-week moving average, which is essentially kind of like the 200-day. We're floating with the 200-week, and there's a long-term PPO, and again, how much it has to move lower with a pretty negative momentum, and everything else showing some negative signs below 40 there, and again, a positive correlation to the stock market. So that's the scariest chart, that XOK is really coming in on a negative, and again, you look at the sentiment, which has been so strongly bullish. By the time we got to 2022, the beginning of 2022, sentiment had already turned south. Both these averages already turned south. We haven't turned south yet. Like, we're still really high. So that's the concern too, is how bearish we already are from a technical standpoint, even with sentiment still as extremely bullish as it is. And when you look at the number of stocks above the 50-day moving average, clearly below the moving average now, right? The moving average at 349, we ended up below 300 and well below the moving average. So that's a negative sign. I already told you earlier in the week, one of the bearish signs we had was this ratio chart getting up above. Sorry, it's not coming up here. There we go. Well, let's try this again. It didn't pop up. Let's give it a second here. There we go. So I told you when this gets above its moving average and gets above 1, that's a bearish sign, and there we are, right? Clearly above. So things are turning south. The number of new lows that the number of stocks in the New York Stock Exchange hits, 115 is kind of the magic number. We got to 98 today, so we're not quite there at that 4% mark, which is the kind of a sign that we are. If we're not necessarily like washing out on a pullback, we're starting one. Like we saw back over here. And again, that number is fluid because the number of issues is 4% of the total issues. But you can kind of get an idea here if I were to. Okay, so that line right there is right around 115, and you can see, how it kind of, that's the level we get to whenever we start these pullbacks. But also you can see like we stayed above that level when we were in correction mode. So we'll kind of keep our eyes on that. The other thing to watch is the number of new highs dropping below its average. So we dropped below this 150 mark, or excuse me, this mark right here where these old peaks were on the average. Now we've dropped below the average at 174, we're at 151. Obviously that's a negative sign. Your new highs and new lows index, when we look at it from a breadth standpoint, we are now negative. Now we're not below minus 100 yet, but we're negative now, well below the average. The skew, which was above 150 from all of last week, finished this week above 156. So like as bearish as we already are, usually when you get a drop like this, you can see the skew drops, and that's a good sign. That's kind of when actually you're bearish, is when the skew drops back below its average. So the fact that the average is now almost 150 and we haven't even like dropped yet. We had a big down week and the skew ended the week higher this week, which means people are very concerned going into next week. If that's that measures fat tail risk. It measures, remember what people are expecting. Are expecting big outsized moves, like more than a standard deviation moves. It puts those demands. So you can kind of see that as well. Like remember how a few weeks ago I showed you this chart where both these lines were up or really high. So the dealer, like right here, we had both the black pool index as well as the retail index both at highs. Basically saying the market is pretty one-sided, and we kind of went sideways for a while, but the retail is really broken down, even if dark pool hasn't. So that's a big change in direction for the retail investor. It's really bringing the gamma risk down there. These charts look at how far away from like the 50-day moving average we are. I'll let those come up here. Oops, I don't want to close it. There we go. So again, from a breadth standpoint, like the average stock is still 1% above the moving average. We haven't broken below 0 yet on that. The number of stocks below their 50-day moving average by 5% or more has really ramped up this week, not surprising. And then the number of stocks above their 50 days broken, like I said, below that 60% mark. So the breadth, as bad as this week was, the breadth does not suggest that this has been a washout week, right? Where we've just washed out with this really, really one-sided oversold market where everybody's on the sell side. That's hardly the case, as you can see eventually here. The breadth is negative, but it's not below minus 35 yet. And you're still, summation index is still very high, right? Like all these other pullbacks, most pullbacks get at least, if not below 0, close to 0. Like this one got to 0. That one didn't. That's what kind of made it very soft. It did not. But all these other pullbacks, you can see this one got below minus 500, almost got to minus 1,000. Some of these other pullbacks got below 0 right there. We got close to 0 over here. We're still at 756. So this, according to the breadth, this is hardly like the bottom of a pullback. So we, again, it looks like there's going to be more to this. Now, that doesn't mean we won't go up on next week, right? I do expect that we'll get a near-term bounce next week. The near-term line will bounce back up. The question is whether it will produce a bullish high point. We've had a bearish high, we've had a bearish low. Will we end this with a bullish high point? And I think that's doubtful. I think the near-term line bounces up above 40, but fails to get above 80, fails to get above the intermediate line, and then we reverse back down for a new leg lower and test these. So, again, you have CPI next week. You have a lot of things before we have the FOMC the week after. But that's the sentiment. So just because we have a lot of signs that are breaking down, and that I expect that we'll get to these lows, and then eventually below that, if we're going to actually have a correction, we're going to get below these August 5th lows. It's not going to happen next week, and it's not going to happen by the end of the month, right? By the end of this month, we'll be testing these August lows, and then we'll be looking for the correction bounce, or the pullback bounce, and whether or not that pullback bounce will fail will tell us whether or not we have a correction on our hands, and not just another little pullback here. And I think that's the case. The former is the case, where we'll have most likely a failed pullback bounce once we retest these lows. But again, next week, most likely, again, the bounce, any bounce we get next week on a near-term basis, we need to watch to see if it gets back above the bull tag high point. If it gets back above the bull tag high point, then we're good to go. We're back. It's a bull tag that continues the bullishness. But if we don't, on like this kind of rally, we tried, but for the most part we were failing, and then that's what happened. Right now, I don't think we're going to get down there in 2 days like this, or 3 days, but that's what happens when we fail to get back above the bull tag high. And so this is the kind of move I expect next week, and this is kind of the outcome I expect next week as well. All right, now let's take a look at our trade idea of the day, and I wanted to take a look at Google for our trade idea. You can see Google has gotten clusters this week already, and then it really broke down today. So 3 clusters, the intermediate line, market sentiment lines in bearish territory. We had already been in the bearish. You can see we already have retested the August 5th lows earlier this week, and now we're below that. So again, what I expect the S&P 500 will end up doing. When you look at the weekly crossover, or the weekly chart, the Hakinyashi chart here, we closed below the 40-week exponential moving average. That's a significant. We haven't had a close below the 40 weeks since, again, early 2022 was the last time we were above it, and we closed below. The PPO is still high, so it hasn't crossed yet. And again, that's kind of the sign when you have the crossover and the bearish crossover here, then we're in correction mode, at least in this individual stock. So we're obviously looking relatively bearish here on Google. 3 red arrow has been 3 red arrows. We're in a current stretch of 3 red arrows now. As was mentioned, we're below the 40-week exponential moving average. That's a proxy for the 200-day simple moving average. So you can see the breakdown we just had here below the 200-day simple, by more than the last little breakdown we had in March of earlier this year, and we bounced up. So we're really kind of moving lower. We had some pretty good volume here. We were into the value area, right? So we were above it. Now we're into it, which means that point of control is going to suck us down. It's a center of gravity when you're inside of it. In this particular case, all these other charts are going to show some bearish signals here. You can see the DMI is clearly bearish, and we've been in this strong bearish trend. Looking at the RSI and the CCI, you can see we've also been in the bearish trend there. We're below 30 on the RSI. The weekly chart's already has been below minus 100. If you look at the Ichimoku cloud and the trend strength, we have a mature bearish trend already. We're below the cloud, negative rate of change. If you look at the Bollinger Bands and the Keltner channels, this new leg lower broke below the band and the Keltner channel. Some increasingly bearish momentum after a brief bullish move. We're red dots. Now we're back to a green dot. So the bands have crossed outside the Keltner channels today. So what I decided to do, it's already pretty bearish. So I don't want to be too aggressive. So instead of selling the low 20s delta, which is pretty aggressive, or even like the 15, I'm going to stay relatively conservative. Sell the 30 delta, so sell the 145, and then buy the 150. So sell the 135, buy the 150. And we'll just position size this for a normal position size. Right around 500, which is our normal position size for a directional trade like this. And you can see we don't have to go very far. I got a lot of wiggle room for us to get to our maximum gain on this. Remember, I have to hold all the way through October. That's another reason why I don't want to be, because we can get a drop and then a bounce back up by the time we actually get to October expiration. We haven't even hit September expiration yet. So that's why I wanted to be a little bit less aggressive on this, even though it could drop a lot further. I want to give it some flexibility on that timing right now, as well as any timing on the exit as well. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.